Ladies and gentlemen, good day and welcome to the earnings conference call of Dalmia Bharat Limited for the quarter ended 31st December 2021. Please note that this conference call will be for 60 minutes, and for the duration of this conference call, all participant lines will be in listen-only mode. This conference call is being recorded, and the transcript for the same may be put up on the website of the company. After the management discussion, there will be an opportunity for you to ask questions. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Before I hand the conference over to the management, I would like to remind you that certain statements made during the course of this call may not be based on historical information or facts and may be forward-looking statements. The forward-looking statements are based on expectations and projections and may involve a number of risks and uncertainties and other factors that could cause actual results, opportunities, and growth potential to differ materially from those suggested by such statements. On the call we have with us Mr. Puneet Dalmia, MD, Dalmia Bharat Limited, Mr. Mahendra Singhi, Managing Director and CEO, Dalmia Cement Bharat Limited, Mr. Dharmendra Tuteja, CFO, Dalmia Bharat Limited, Mr. Rajiv Bansal, Group Head, Strategy and Transformation, and the other management of the company. I would now like to hand the conference over to Ms. Aditi Mittal, Head Investor Relations. Thank you, and over to you, ma'am.
Thank you so much, Stephen. Good morning, everyone. Wish you all a very happy new year and a very warm welcome to the Q3 earnings call of Dalmia Bharat Limited. Hope you all had a chance to go through the results and the earnings presentation, which as we speak can also be downloaded from our website under the investor section. Without taking much time from here, I'll hand over the call to Mr. Dalmia for his opening remarks. Over to you.
Thank you, Aditi. Good morning, everyone. It gives me great pleasure to welcome all of you to the Q3 earnings call of Dalmia Bharat Limited. Warm greetings of the new year, and we sincerely hope that you and your family are safe, healthy, and vaccinated. The last quarter has been a tough one for the industry, as there was muted demand on one side, and on the other side, there was a pressure on costs. Moreover, the last 2-3 quarters, we have witnessed an unprecedented increase in the energy and commodity prices, and whose impact has finally started to reflect in the earnings of the industry. If we do some broad cost comparisons of our key inputs, the consumption rate of petcoke has almost doubled from $83 per ton in Q3 of FY21 to $164 per ton in Q3 of FY22. And likewise, if we see the coal consumption rate, it has gone up from $82 to $127 per ton over the same period, which is an increase of 55% in coal rates in a year's time. As a company, while we were able to mitigate some impact through our system's flexible operating structure and real-time changing the mix of fuel, yet the fuel cost has heavily impacted us. And likewise, if we see, the entire industry's margins have felt the real heat of the spike in fuel costs. Cement being a very localized and regional play, each region was seen performing very differently, and we witnessed that the compression in demand was maximum in East, followed by South. November was an absolute washout month, and varied factors such as monsoon and sand mining issues were the key downward drivers for cement demand in East and in the South. And in the South, it was unseasonal and extended monsoons, which had adverse impact on the demand. Having said that, December saw a rebound and growth, and the trend continues this far in the month of January. Mr. Singhi will later take you through the numbers and some broad trends in more detail. Beyond the quarterly blip, the outlook for the industry remains intact and is positive. Capital expenditure remains one of the key pivots with the government if they are able to stoke up growth amidst the pandemic. Despite the second wave impacting beginning of the current financial year, in H1 of financial year 22, the government was still able to meet 41% of its capex target from the overall budgetary allocation of 5.54 lakh crore. From the upcoming budget, we expect that the absolute allocation towards the development capex should only get higher, which in turn would have a multiplier impact on the economy and particularly the building materials sector. While private sector investments are still a far cry, the recent deleveraging of the balance sheets of Indian corporates and the continued fiscal and monetary support by the government and the central bank pose a strong case for uptick in capex from the private sector. We remain excited about the opportunity that lies ahead, and we are diligently pursuing our capacity expansion initiatives to be able to meaningfully contribute to the increased cement demand. Further, in line with our vision to build a pan-India cement company, we have diversified our manufacturing presence into the western part of the country with the commercialization of our Murli plant in January 2022. We are not only making investments to add capacity, but also planning and executing for improving the operating efficiency and sustainability quotient of our business. Initiatives that would mitigate the impact of external volatilities and contingencies are an area of focus for us, and as a team, we are working on further strengthening the foundation of our company. We have accordingly laid out specific short-term target for enhancing the renewable power percentage, the green fuel consumption, and the blended cement percentage in the company. During the quarter, we also actioned upon our commitment to the shareholders and have completed the divestment of the retail venture, the Hippo stores, through a slump sale. Part consideration of 35 crore has been received upfront, and the rest of the details on the same will be shared by Dharmender later during the call. I thank you all once again for your valuable inputs and constructive feedback. We will continue to seek your guidance, support, and feedback from time to time. I would like to hand over the call to Mr. Singhi for an update on the quarterly performance. Thank you.
Thanks, Punitji. Happy morning, friends. Hope all is well at your end and that your families are safe and healthy. As Punitji has already mentioned, Q3 has come in as a bit of surprise for us, where sales volume fell short of expectations. On a YOY basis, there has been a volume degrowth of 2.5% in Q3, and total volume for the quarter is 5.7 million tons. While we say that, the last 10-15 days of December saw a visible growth in demand, and which has sustained during the month of January this far. While the capacity utilization for quarter is average 69% for Q3, for the month of December it rose to 83%, which shows that demand is going up. During the last quarter, the weakness was primarily driven by weak demand scenario in East and to some extent in South. Our volumes in East contracted by close to 12% on YOY basis. The silver lining, however, was that sequentially there is an almost 23% increase in sales volume. On other key markets, South, too witnessed extended monsoon, but in spite of that, our teams were able to continue their journey of increased market share, and we were able to deliver a volume growth of almost 2 to 3% on YOY basis. Seeing the demand trend of second half of this month, we believe demand to stay strong as usual in Q4, and we may witness a robust Q4 same as last year. For all India basis, we expect cement demand to grow around 6 to 7%. Having said that, on full year basis, our demand growth could get contained to mid to high single digits as against the earlier anticipated 11 to 12%. And this is primarily owing to unexpected demand sluggishness of Q3. In terms of pricing, the prices have shown strength on YOY basis. As we exited the month of December, due to the demand pickup which observed in last 2 weeks of December and first 3 weeks of January. The exit prices in East looked a shade better than the December average price, and we hope that as demand scenarios improve from here, the same should follow in the other regions as well. Also, as is seen each year, the increase in demand should lend some strength to the prices across regions. The expected support in prices should be driven not only by a better demand scenario, but also due to pressure of high cost in the cement sector also and other sectors also. If we speak of ourselves as a company, the trade percentage for the quarter was 59%, which is again below our desired level, and going forward, we would be improving it. As we have been working on increasing share of premium products in a sustained manner, we are happy to share that the share of DSP as a percentage of trade sales stood at 21% during the quarter as compared to 18% in the same quarter last year. On the cost front, this quarter, as Punitji has highlighted in a major way, we have seen that the inflation in the energy and commodity prices has finally started to reflect the cost structure of the company. The lag, as we all know, was due to the low-cost opening inventory, which has been exhausted across both companies. In line, if you see, on sequential basis, the raw material cost has remained flat and is in fact slightly better due to a very moderate positive change in slag cost. The real debt has been due to the high fuel cost. The average consumption rate of petcoke and coal, which makes up almost 75% of our fuel mix, rose to almost $160 per ton. This is as against an approximate number of $130 during Q2. Since the purchase price of fuel was higher at closer to almost $200 in Q3, the Q4 consumption rate should inch up slightly more due to the availability of high-cost opening stock for Q4. But at later part of March and then early April, I think the softening of petcoke price may show some signs. The freight cost during the quarter has increased modestly QoQ due to slight increase in the lead distance. Our lead distance during the quarter had increased to 298 km as against 285 km in the previous quarter. On YOY basis, while the diesel cost increased to a staggering 21% to 94 rupees a litre in the current quarter, our efficiency measures helped to contain the adverse impact in logistic costs. On an overall basis, the increased cost as seen in Q3 will probably sustain and remain at these levels for the rest of the FY22, like the Q4, due to some of the high cost opening inventory before they eventually start to taper down. Friends, on growth part, we have spent close to 1,350 crores in first 9 months of the year, and considering the current plan, a further outlay of around 800 crores is expected in Q4. While the absolute expenditure number has fallen short of our estimation, we continue to be on track to complete the capacity announced up to 48.5 million tons by March 24. We are fully confident of completing plant commissioning as per our current plans, which has been shared with all of you. Just to detail out the capacity growth plans a little more for you, we are expecting that 4 billion ton of debottlenecking should get completed by March 23, and we could expect the grinding capacity to reach 40 million ton by June 23. The initial work has already started for Bokaro and one of the Tamil Nadu grinding unit. We are shortly finalizing the Bihar grinding unit site location and would share surely with you in our next call. Like we had mentioned in the last call, that mill order has been placed for all 4 locations and we are on track to meet our March 24 timeline. As Punitji has highlighted about our entry to West, we have commercialized the 2.9 million ton plant of Wood Industries in Maharashtra on 15th January, which makes and marks the beginning of manufacturing capacity in West, and it fits strategically in our long-term vision of building a pan-India company. The plant is supported by a clinker line of 1.98 million tons and has capacity power of 50 megawatts. The total installed grinding capacity of the company stands at 35.9 million tons and clinker at 18.88 million tons. We are making all efforts also to augment the limestone reserve for the plant in Morbi area. Continuing on limestone, I am delighted to share with you that we have won in limestone block auction in Rajasthan area, that's in Jhunjhunu district of Rajasthan, which is closer to NCR and in part of Rajasthan. This block is located exactly in Nawalgarh area and estimated to have a mineable reserve of 160 million tons as per the government records. Friends, we at Dalmia Bharat always take pride about being the company with one of the lowest carbon footprints in the global cement world. During the quarter, our CO2 emissions have again came down further to 488 kg per ton as against 492 kg per ton for FY21. To carry forward our journey and to put more focus on sustainability and ESG, we have, during the quarter, appointed Dr. Arvind Bodhankar as our head ESG. He will also be playing a dual role of Chief Risk Officer and would help the organization assess, strategize, and mitigate against significant organization risk also. With this, I would now like to hand over the call to our CFO, Mr. Dharmendra Kuteja. And thanks, friends, for your patient hearing.
Thank you, Singhi. Good morning, everyone. In the interest of time, I'll quickly jump into the key financial updates. The moderate increase in absolute other expenses on YOY and QOQ basis is due to the increase in travel expenses due to ease in travel restrictions and also the increase in selling and advertising expenditure. The packing expenses have also gone up on both YOY and QOQ basis. The packing cost saw a sharp jump due to the increase in the input costs, where the PP granule price escalated by almost 40% from average rupees 90 per kg to about rupees 124 kg on YOY basis. On the balance sheet side, as a priority set out in our capital allocation framework, we will continue to maintain a razor-sharp focus on the health of the balance sheet and the various return ratios. During the quarter, we have availed a gross debt of close to rupees 538 crores, which is net of repayment of rupees 856 crores, and the closing debt as on 31st December stands at 3,647 crores. The net debt to EBITDA as on 31st December was negative 0.64. Also, in line with our capital allocation framework and our vision to build a pure play cement company, the sale of Hippo Store has been concluded on 31st December on a going concern basis by way of a slump sale to Hippo Store Technology Private Limited, which is a promoter group company, and this is for a consideration of rupees 155 crores. The company has received rupees 35 crores and balance has been received in the form of NCDs carrying coupon rate of 10% per annum, and these are redeemable after 2 years. Overall, pre-tax net gain on Hippo Store's sale is rupees 6 crores and is recognized under discontinuing operations in financial results. During the quarter, we have not sold any further shares of IEX, but as has been asked by many, we would like to reiterate that we are committed to building a pure play pan-India cement company, and we will continue to revisit our investment in IEX from time to time. In this quarter, we have accrued 44 crores of incentives, which takes the 9-month accrual number to about 180 crores. The collection during the quarter has been rupees 20 crores, and the total collection for 9 months FY22 has been close to 160 crores. With this, I now open the floor for questions and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Indrajit from CLSA. Please go ahead.
Hi, good morning. Thank you for the opportunity. Couple of questions from my side. First, can you throw some more light on demand? How do you see demand panning out in fourth quarter? You mentioned that it is improving, but is it just on a QOQ basis, or do you think after a blockbuster quarter last year, we could see some growth on YOY basis as well for the industry, not for us, but for the industry?
Yes, you are right. This would be better on YOY basis also. And one of the reason may be that the pent-up demand of Q3 may also come up in Q4, and that's why it looks like that demand should be better in this quarter, YOY basis also.
Sure. Thank you. Secondly, on the Rajasthan block, any initial thoughts when we can start producing from that block, or what is the kind of timeline we are looking at? Will it be for part of that your 48 to 62 million ton, or will it be beyond that in terms of production and capacity?
One, I would say that we have been able to run this block just 6 days back, and now all initial work has to start. Second, this would come beyond 60 million ton, and because the major task would be to acquire the land and then to start various activities. So this will be beyond 60 million ton.
Sure. Thank you. Just 2 housekeeping questions. Can you please repeat the 9-month capex number and the cement clinker ratio for the first 9 months?
The cement clinker ratio is yes. Please go ahead for the capex.
Capex number has been 1,300. Yes, please.
And CC ratio for the first 9 months is 1.62.
Sure. Thank you so much. I have more questions. I'll come back in the queue.
Thank you. The next question is from the line of Girish Chaudhary from Spark Capital Advisors. Please go ahead.
Yeah, thanks for the opportunity. A couple of questions from my side. Firstly, on the eastern region pricing, just wanted your thoughts. The pricing continues to be very weak. And if I look at the difference in east pricing versus some of the other regions, this has widened. So just your thoughts from a very medium-term perspective, given your leadership in this region.
Yes, you might be aware that east is having one of the lowest per capita consumption in comparison to other regions of the country. And it is expected that in the midterm, the demand should go up in a big way, and which should lead to the better prices. Of course, presently the prices of east are lower than southern India or northern India, and we are hopeful that with the increased demand and of course the increased cost would also help the organization to have better prices.
But do you expect a strong catch-up in the east region in the medium to, let's say, over the next year or so?
This will mainly depend on the demand scenario. If demand continues to remain better, then yes, we can expect better prices, like what we have seen in the month of January also, that with the improved demand, the prices have started going better and better.
Okay, fair enough. Secondly, again, good to see the commercial production of Murali Industries asset. Again, if you could share your outlook on what kind of ramp up we can expect in FY23. The reason is that recently we also saw Birla Corp commissioning a pretty large plant in the same market, 4 million ton, and your capacity is also close to 3 million ton, so 7 million ton new capacity in the same market. So what kind of ramp up we can expect?
We can expect shortly more than 60% capacity utilization for FY23. We have already set up our good marketing network, and that will help us. And to some extent also, our presence was there in Maharashtra. On that account also, we are getting good response in the market. So we expect that minimum 60% would be there in FY23.
Got it. So just a follow-up on this, finally, is the cost structure of this asset higher or lower than the company average? What is the sense on the cost structure?
In few months' time, it will be almost equivalent to the company's average variable cost.
Got it. Thank you, sir. All the best.
Thanks.
Thank you. The next question is from the line of Swagato Ghosh from Franklin Templeton. Please go ahead.
Yeah, thank you. My question to Puneet sir and Rajiv ji. So basically, slightly atypical question. If you had to start all over again, and if you had the option of choosing any two regions, if you are free to choose any two regions, which two regions would you have your presence in, considering everything?
So, this is Puneet. I think personally each region has its pros and cons, and I cannot take a short-term view. There are times when South has performed really well as compared to North because prices have been very good in Tamil Nadu and Kerala. There have been times when East has done really well. There have been times when Gujarat has done really well and it has not done well also. So I think if I take a long-term view, I personally don't see that there is huge disparity between regional performances. They could be quarter to quarter, and maybe some years, 1 or 2 years could be here and there. But if I take a 5-year average or a 10-year average, there is not much disparity between regions. I think what I like is in terms of our footprint. I think we have a great footprint in Deep South, where there is continued demand growth and a very good consolidation in the market in Tamil Nadu and Kerala. Andhra, Telangana remains a weak market, and that's an area where we feel it will take some time to sort out the industry structure. However, East India we really like as a bet in long term because it has the lowest per capita consumption and great mineral resources in the country, and a lot of private capex is going to happen given how well the steel sector and the coal sector is doing. So I personally really like the eastern markets. We also like Northeast a lot because even though it's a small market, it's a segregated region and a place where we have a very strong brand. I think even in Central and North India, we had aspirations to enter. We did bid for Binani. We like that market as well. But I think it's difficult for me to choose one market over another. All I can say is that the more diversified you are, the more you can, withstand the volatility that comes year on year or sometimes quarter on quarter. So diversification helps you manage volatility. But overall, if I look at this a sectoral view, I think the fortunes of this industry is dependent upon the housing and infrastructure build out in this country. And my personal view is that we have a very strong demand environment likely in the coming decade. And also the entry barriers in this business are rising. It is difficult to build new plants. It is difficult to buy land, and it is also difficult to build distribution and your brand. So my personal view is entry barriers are rising, and it's never been a better time to be in this sector. So overall, I don't think I can answer your question that I'll pick one region over another, because long term every region performs reasonably well, except I would say Andhra is perhaps the most fragmented market, and perhaps the structurally least attractive. And also, I think Himachal Pradesh is one where I think the cost structure is really high because it is locked up in the hills and all the demand is in the plains. So apart from Himachal and Andhra Pradesh, I think all regions have their own pros and cons, and over a period of time they normalize. So I think it's difficult for me to answer that question in an academic manner. Since we have a pan-India play aspiration, we like the idea of diversification, and I think we are quite bullish about the fact that structurally this industry is heading in a good direction.
Fair. And one follow-up to that is, in the eastern market specifically, can you or some of the other market leaders drive the pace of consolidation a bit faster so that the market reaches some profitability level and attractive point faster?
Look, I'll tell you, I think, already about top 5 players control 80-85% of the capacity in this region. So it is already a fairly consolidated market. My view is that if you look at even the announced plans of the most players are serious players and large players are adding capacity in this region. So everybody sees this as a long-term, very attractive market. Otherwise, they would not add capacity. So my personal view is the degree of consolidation is already pretty good, and I don't expect further consolidation in this region in the short term. But the real question is how quickly can the demand come up? And regarding prices, I think as demand grows, pricing should stabilize. That's our view.
Fair. And one last question from my side. On the Murli asset, there was a bit of an issue with the limestone. So when you're talking about ramping up 60% capacity, etc., so are we sourcing limestone externally, or the reserves we have is sufficient for doing that?
We have sufficient reserve, and we'll be able to ramp up the capacity utilization also, and we are quite confident that in time to come, even we may go for further adding up the capacity also.
Okay, thank you.
Thank you. The next question is from the line of Pinakin from JP Morgan. Please go ahead.
Yeah, thank you very much, sir. So my first question is just trying to understand, in your view, given that Dalmia Cement is a sizable player both in Eastern India and Southern India, and you mentioned that Eastern India is already fairly consolidated. But even keeping the last quarter aside, Eastern India's pricing has been relatively been much more weaker than Southern India, which on paper has a higher degree of underutilization. So what in your view differs between South and East, or what would need to change in East to have a similarly, upward moving pricing environment?
I would say the major driver for this would be the continuous increase and sustained demand. What has happened in East many times is because of either cyclone or unseasonal rain or the sand mining problem, etc. There has been the disturbances on account of which pricing have not got stabilized. But otherwise, to us, it looks like because you are fully aware that all major players they have good presence as well. They have also gone for capacity expansion in this area, which means that each and every player looks at the better time in East. So accordingly, one of the major area for which the prices can remain stable is the good demand.
If I can just add here, Rajiv here, I think, catching on to what Puneet and Singh said in the previous answers, see, we're very bullish on East. East has one of the lowest cement consumption, per capita cement consumption in the country. And a lot of economic activity happening there, pragmatic government. There's a lot of focus on increasing spend on infrastructure in those states. And given that we have a very large presence there, we are also seeing that competition is increasing their capacity there. The fact that everybody is in the East means the East definitely has a huge potential, and we being there and having a larger exposure, I think puts up in a good place in the medium to long term. As companies add capacity there, initially you see price volatility. As everybody is trying to increase the utilization initially, the price volatility will continue. But I think over the next few quarters, you will see that the price starts stabilizing in East, because most of them would have ramped up the capacity to a certain level, and then you will see with the increasing demand, the price starts going up. So I think if I look at from the next 1 year perspective, you should see that demand growing in East and the price stabilizing as the capacity gets ramped up, and you will see price stabilizing. So I think from a medium-term perspective, I'm personally very bullish on the Eastern market, given the economic conditions.
Fair enough. Thank you very much. My second question is, if I take a step back and I look at the last 5 quarters before the December quarter, both Dalmia Cement and the industry had record profitability, record high EBITDA per ton. Now, at this point of time, given what the announcements are from Dalmia, Shree, Ultratech, ACC, Ambuja, and others, very clearly the next 3 years would have capacity addition far in excess of what the last 3 years were. Now, demand would grow, but is it fair to say that barring a commodity price, coal price collapse, we are unlikely to see a repeat of the profitability that we saw in the calendar year 2021 for most quarters?
I would say one of the major dent in this year and in this quarter has been the energy cost. So once energy cost gets stabilized of the previous period, then I think the EBITDA can be as good as what it was earlier, because we do expect better demand and stabilized prices. The major change which has come in is about the high cost of coal, petcoke, domestic coal, everything.
Understood. Thank you very much, sir.
I would just add to what Singhi is saying. I think there is obviously going to be a larger capacity addition compared to the last 3 years, but I also see an increase in demand, and personally, my sense is that if input price rises so suddenly for the entire industry, typically a few percentage points rise can get absorbed, but over a period of time, if like there's a 25% cost hike, input cost spike, then typically over a period of time it gets passed on. So my view is that given that the entry barriers are rising in this industry, I can't predict the next few quarters, but my sense is that I structurally believe that the profitability will reach the original levels of between 1,200 to 1,500 rupees per ton of EBITDA. It may take a few quarters, depending upon how the demand-supply situation is, but eventually I think it will get passed on, is my sense.
Understood. Thank you very much. This is very clear.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So taking further the discussion of Eastern market, so like Puneet, so how you mentioned that top 5 players control 80%, but my understanding is that the top 5 players actually are all equally big. I mean, give or take 3-4% here and there, and they all have ambitions, which we can see in the expansion plans. So that really the top 5 80% is not helping. I mean, all of them are fighting with each other, as we can see in the market. So when do we see a more like a normalization of that heightened competitive intensity in the market? Like demand is a good thing. East has good demand potential, but more or less it has turned out to be a bane rather than a boon, given how everyone is looking to add in East. So like when do we see this heightened competitive intensity go down amongst the top 5 players themselves?
I think, look, this heightened competitive intensity gets magnified in a weak demand environment. If you look at the last quarter, in East India, there was a demand compression of almost 17%. So when there is such a steep demand compression, I think, everybody tries to sell a little bit more in November, and you don't have perfect data. In November, it was a complete washout month. So my personal view is that, this one quarter was a steep demand compression coupled with a sudden spike in input costs, which was very steep. We are already seeing that in the, fourth quarter, demand is coming back quite strongly. December was good. January is also good. Fourth quarter, there's a little bit of seasonality as well, but the demand is coming back. Now, I think my sense is, as I said, I mean, I don't have a crystal ball in the future, but, such large input price spikes typically get passed on unless the demand is there's a huge demand shock. But if demand is continues to grow normally, I think in a couple of quarters at best it should get passed on. Maybe earlier.
So I appreciate the November point, but the thing is, in the last 4-5 years, East has hardly seen any price hike. It's not just about one quarter, whereas all other regions, if you see, like price points have all moved up. So, and next 2-3 years also, we see a big pipeline of additions in East. So the question comes more from there, like demand is good, but then capacity supply just kind of like removing all the advantages that demand can bring in.
Yes, I think in the short term, what you're saying is, has been true. But I continue to believe that this is perhaps one of the most attractive regions in the country. And both the demand and the pricing growth will surprise us. Now, whether it will happen in 1 year, 2 years, or 3 years is difficult for me to say. But my sense is that it's going to surprise us. And that's why at least we are investing. That's the bet we are making. Now, time will only tell whether we are right or wrong. But we are quite confident about this region.
Sure. And the last one from me, like going ahead, like you've announced your expansions, which again are centered a lot on East. But going ahead, would you look to do your next leg of expansions beyond East, let's say the northern limestone you have, or some other regions?
Yes, I think we have already given a guidance that our aspiration is to be a pan-India company. And, we are looking at, projects in other regions as well. But having said that, we are also investing in South. So we are putting up grinding units in Tamil Nadu, and we are making significant investments there. And also in the Western region, we have invested in Murli. So I think, we are investing in South and West as well in our current phase of expansion of 48.5 million tons. But we are looking at other regions as well, and our aspirations continue to remain more diversified across regions.
Okay, sure. That's helpful. Thank you.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, thanks. Firstly, thanks for the detailed opening remarks, and also great to see the closure of Hippo store divestment in line with our capital allocation policy. First question is on the capex. Now, in the last quarters, we've cut our capex guidance almost half, from 4,000 odd crores in FY22 to now closer to 2,000 odd crores. And at the same time, we are maintaining that none of our expansion timelines are being compromised. So is it possible to share some more detail as to why these delays or lower capex in this year? And also, how do we see FY23 and 24 capex now shaping up in the light of this delay? Do we still see around 3,000-4,000 per year, or some spillover of this year?
Let me share that one. Whatever, say, actions which we want to take to ensure that we are able to commission all of our 48.5 million ton capacity, that is, we have already taken in most of the areas. And on that account, we have already invested 1,350 crore, and we are expecting maybe around 800 crore. I do accept that, yes, earlier we were thinking that we may be able to spend maybe around 2,500 to 3,000 crores. But looking to the situation, we have already decided that in next 2 quarters, there will be like the quarter first and quarter second, there will be more expenditure on expenses, and that will take care. And I can again reassure that whatever actions we have taken, we will be able to complete all the expenses by March 24. We are also one of the major steps was to order for the grinding system, so that has already been done. We have already started work on the 2 grinding units, and 2 others they are in the process of finalizing. So this all augurs well for completing 14.5 by March 24.
Okay, so total 10,000 odd crore capex, the remaining we'll be spending in FY23 and 24. So that gives us 4,000 per year. Is that the right understanding?
This is inclusive of the capex which we are having on other areas, on green power and other areas also, and then maybe Aditi will be able to share the full detail about that capex.
So, Sumangal, Rajiv here, if I can add to what KG is saying. See, what has happened is the 48.5 million that we have committed to the street by FY24 is intact. All the investments which need to be done, which are on critical path for achieving that capacity by FY24 is being made. When we initially given our estimate and came with the whole capex plan, and in line with our pan-India vision, we had also allocated some money for looking at new regions because, as you know, the land acquisition, getting the raw material security, everything takes time. So we had actually started on that. We have been looking at good assets. We have been looking at good locations and land banks and everything else in different regions. And that part has got delayed because we still are in the process of identifying the right assets, the right lines. And so what the expansion beyond 48, some part of the money was supposed to spend in FY22, but some of that has got delayed by a couple of months here and there. But overall capex plan, overall capex expansion thing that we've spoken about remains intact, and we are in track to do 48.5 FY24 by 60 odd million tons by FY25. So those are intact.
Understood. Thanks. Very clear, Rajiv. Second question is on the cost. You did share some details in the commentary, but just to confirm whether I've understood it correctly. So we are seeing cost in March falling, but at the same time you said that starting cost given the inventory etc. will be higher for this quarter. So any sense on the overall average basis, do we see cost peaking out in third quarter and deflating from fourth quarter, or only on a run rate basis March will start deflating and actual you will see some benefit in 1Q only?
I would say that Q4 of this year, the cost part would almost remain the same, and maybe few rupees here and there based on the coal prices on local basis. But of course, from Q1 of FY23, it will surely tapering down.
Okay, understood. And just one last clarification, given that we won a virgin mine in Rajasthan, I mean, by which year can we actually see a capacity footprint in North? Is it fair to assume that it will be more towards the end of this decade or a bit sooner?
Like I said earlier, that we have just won it, and we are exploring all the possibilities. And maybe in 1 or 2 quarters call will come out that what our action plan is.
Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
So thank you for taking my questions. So my first question is on demand. If I look at your trade to non-trade ratio, clearly the impact this quarter, not for you, but for the broader industry, has been much more on trade. Whereas when we talk about these factors like rainfall, etc., they should logically impact both trade and non-trade equally. I'm just trying to understand, is there a bigger worry on trade demand? What is your thought on that, or you still think that trade is as robust as what it was and should come back? That would be my first question.
Yes. What has happened is that even in the tough time also, when there's rains and everything, so wherever there is a structured work going on, where there's a big real estate player or the road work is concerned, that goes on. But the individual house builders, etc., their work goes down. And more particularly, if I talk of East, this time in general also, the rural demand has gone down. There has been a slowdown even in rural economy also. And on that account also, the trade percentage for us also, and maybe for others also, it has gone down. But then to us, it looks like it was a temporary phenomena. And in time to come, it will again go up. And with the increased demand, the trade percentage will go up. Yes, please.
Sure, sir. So because that's the worry, because everybody is talking about rural continuing to be slow, so we'll have to just wait and watch how that plays out. So my second question is this interesting exhibit that you have put on slide number 21, where you talk about how usage of green fuel has actually contributed to higher savings. Now, structurally, obviously, Dalmia is doing a lot more. Other companies are also focusing on more WHRS, solar power, etc. Do you envisage that the saving that will come on account of this will actually contribute to EBITDA, or will it result in prices probably increasing at a much slower pace? This is more like a structural thing over the next 2 to 3 years. How do you see this playing out, contribution of green fuel and the savings there? Will it be a EBITDA contributor, or probably prices increases a lot lower?
Ultimately, it has to be EBITDA contributor, because the more we are able to use green fuel, then definitely that takes care of the volatility of the fuel prices. So that would be the EBITDA contributor, and efforts are on to ensure that yes, whatever work we have done, we should continue and we should announce that.
Sure, sir. So,
Sorry.
Go ahead, please.
If I can just add, the question is that, when we are seeing a steep increase in input prices, we are not able to pass it to the customer. But if there is savings because of all the initiatives, would it get passed on to the customer, right? And whether it is result in prices coming down. The fact is, price is a combination of multiple factors: demand, supply, input prices, ability to pass on the price, competition. So it's very difficult to answer the question saying that whether it will get passed on to the customer when it results in lower prices. The fact is, all the companies are working for a certain, targeted profitability and a certain targeted growth and etc. So I think we'll have to see how it plays out. But the idea is how, as Riji was saying, how do we reduce the volatility in our input costs, in our fuel costs, in our other input costs, by taking some of the initiatives which will kind of ring-fence me from this volatility outside. That's the whole idea, right? And it also helps in EBITDA. It also helps in being more predictable.
No, fair point. Thank you so much.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good morning. So again, my first question, pertains to East. I do agree with a lot of comments you made, but my only concern is that if you go back in time, 10 years back, the industry had the same commentary for southern region also. When AP, Telangana, they were seeing very strong growth, and today, like you highlighted, AP Telangana is seeing the worst of demand. The concern really is, with such a strong demand growth in East, capacity utilization upwards of 90%, the pricing strength has just been, missing for the last, say, 3 to 4 years at least. So, though obviously East, the per capita consumption is lower versus what South was in 2010, so that does give some comfort on the demand potential. But purely from a pricing point of view, what do you think should change or needs to change? Or, is it like competition which can then sustain for much longer because everyone is in expansion mode? So any comment you can make on, how to think about pricing from here on for East?
I would say that demand will play a major role in stabilization of prices, and like Punitji has also said, and I also said, that in time to come, the demand would shape up, and that's the major driver for pricing. Otherwise, whether you have the lower cost, higher cost, that may not mean much for the pricing settlement. And in other regions also, we have seen that 2-3 years maybe of lower price, 2-3 years maybe of higher price. So here, since all players are also quite hopeful that East prices would go up with the demand, and that's why everybody has thought of putting up the capacity. So that way, we are quite hopeful, and that's what I can say.
Okay, got it. Sir, also, you kind of reiterated your, target of going from 48 to 60 million tons by 25. Given it would take at least say 18 to 24 months for that, can you give some roadmap in terms of what we are planning for that 48 to 60 journey in terms of either region or a preparedness, or does it include fair bit of inorganic within that number? Because otherwise, in 1 year, if I think from 48 to 60 looks like a humongous target.
No,
Sorry,
Rajiv, sir, go ahead. No, see, you're looking at from 1 year 48 to 60. No, that is not the way to look at it. See, when we roll out our capex plan and we said it for the capital allocation, we did say that 48.5 by FY24, 60 by FY25. So a lot of that work is starting now. As I was telling to a question from Sumangal, a lot of land identification, lining up the supply chain, everything, the work has to happen now. So it is not that we are going to look at doing something only once we complete 48.5. The whole idea of rolling out a long-term capex plan was to say that as a company, we are going to focus on these milestones and the work for them. When you work backward from them, you start planning and tying up a lot of these stuff ahead of time. So it is not, don't look at it as a 1 year. It is, we have more than 3 years from now to build another 11.5 million tons. That's how we would look at it.
Rajiv, I get that. In fact, that's precisely the reason, I'm saying, given we would have already started working on that 48 to 60 journey, we should have fair bit of idea in terms of which regions and all we are targeting. So any thoughts you can share on that? Because at least, the board level work would have started on that.
So we did say, when we said last time, the 40 to 60, you will see some part of it in the existing region and some part of it in the newer region. And that is what we are working on. At this point of time, to really give more details would be premature. I think we'll have to wait for us to be able to announce at the right time. But again, coming to point, 60 million is something that we feel very confident about FY25. 48 to 60, a part of it will be in the existing region and a part will be in the new region.
I just have a small follow-up on that, but safe to assume the way things stand today, 48 to 60 is mostly organic. We're not building in any inorganic opportunity in that?
Inorganic, you cannot plan 3 years ahead of time.
Right.
Because if you get something great at that point of time, you look at it. Yeah?
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Gaurav Jain from ICICI Mutual Fund. Please go ahead.
Hi, sir. Thank you for taking my question. I just have two questions. One is, you mentioned the capacity utilization for the quarter and as on December. It will be really helpful if you can also share the capacity utilization that we are currently operating at around. And second is, while we understand the issues the industry faced in November, etc., are there any visible green shoots that we are seeing? And if yes, then from which segment are we seeing the same IHB, rural, government, etc.? It will be helpful. Thank you, sir.
We would be operating in this quarter, last quarter, between 80 to 85%. And second question is that there are green shoots, and because one, in East, said mining issues, they have been resolved by the government, which has again favored the demand in Bihar and West Bengal. And secondly, now in the southern part of India also, the sudden rains, etc., those problems are not there. So in both the areas now, we do see that the demand should come up, which will help us in our capacity utilization also and good volume also.
I just want to add to that, while, we went up above 80%, I think around 85% in December, but I think in January we have commissioned Murli. So on a blended basis, this number will come down and it is likely to be between 70 and 75%. So we can't ramp up Murli to 80% suddenly. It is going to take time.
Right.
So basically on the existing capacities, we expect it to close at kind of 80-85 for Q4, right?
Yes. Other than Murli, yes.
Understood. Okay. Thank you, sir.
But on a blended basis, between 70 and 75.
Thank you. The next question is from the line of Kamlesh Bagmar from Prabhudas Lilladher. Please go ahead.
Hello.
Yeah, go ahead.
Yeah. So one question on the part of the expansion. So we had given our guidance and all that. But if I see your capacities currently in Tamil Nadu, So they are operating at hardly around 55, 56%. I'm not taking the current utilization levels. It is impacted because of the rainfall. But even if I go to FY18, 17, all those periods, all those utilizations have been hardly around 55, 60%. And at that time, Tamil Nadu was doing very well. And on top of that, we are guiding that we are going to add 2 odd million ton through the greenfield unit. So when your utilization levels at the current capacities are below like say 60%, so what incremental supplies they are going to add? Is it more of a like just a capacity, or is it going to really flow to the volumes? And even if I see your northeast capacities, say almost like say taking Adhunik under belt for last roughly around 7-8 years, it is operating at hardly around 55% utilization levels. When utilization levels at the existing capacities are at such a low level, and we are saying that we are going to add like say around 20 odd million ton capacities, so how they are going to flow actually to the volumes part?
If you now look at our capacity utilization, even for our Tamil Nadu plants or the southern plants also, they are ranging 70-75% plus. And if we talk of last 5-7 years, there was a different scenario of the demand in south, different capacities in south. But at the same time, if you look now, not only of Dalmia Cement, but a few other cement companies in south, you will find that capacity utilization to some extent has gone up. We are quite hopeful that we should be able to capture good market share in the increasing demand, and that's why a conscious decision, which is a good for a good market. You are also aware that now, since last 1.5 or 2 years, the demand in Andhra has started going up. Then the way industrialization is happening in Tamil Nadu, that is also sounding well for high demand. And it's just preparedness, and I'm sure this preparedness will help us in not only getting market share, but better profitability also.
My comment was particularly to my comment was particular to the Tamil Nadu market only.
Yes,
and contrary to what Puneet's comment was that Andhra and all those markets are not doing well. Your utilization levels at the Andhra and Karnataka market are far better than what Tamil Nadu is doing. They are upwards of, my estimate suggests that they are upwards of like say 90% levels. So I was only talking about your Tamil Nadu plants. So there the utilization levels are very low.
In our case now, the utilization level of Tamil Nadu plant is 70% plus. And that's why we are quite hopeful that with the new demand to come up in this area, which is both Tamil Nadu and Kerala, we should have extra higher capacity, which should be able to give us good market share. And since you referred about last 7-8 years, and that's why I said that the demand in Andhra has also gone up. Yes, please.
Yeah, and so lastly, so we have been guiding such a elevated capex, which is very positive. But even on the short term, this question has been asked. But like say, if you see any other company, be it Ramco, Ultratech, they are delivering much higher than what they have been guiding on the capex side. But in our case, we are like say the plants are so high, but ultimately on the ground, the activity is so low on the capex side, at least on the capex side. And the way the capacities are situated, like in the east market, particularly on the Odisha, there is no clarity how much limestone reserves we have, how much useful life left there. There are a lot of land acquisition issues are there. So honestly, like on this capacity addition side, there has been very low confidence on how we are going to deliver on that part. And majority of our capex is through debottlenecking or the grinding capacity addition. But honestly, on the clinker side, there has been not a significant development in terms of a capacity addition.
First, let me assure you that we have sufficient limestone deposits. We have sufficient limestone lease in Odisha, and that's why there is not concern, and that's why we have gone ahead for putting up one of the big kiln in Odisha. Secondly, I would say that whatever we had committed for FY22, we are on the mark. We have achieved 35.9 million ton capacity. And third, as we have reassured that the work for 48.5 million ton is going ahead, and accordingly, capex is, yes, a few hundred crores here and there. That is varied because of certain circumstances, but at the same time, the work which was to be done for achieving this capacity, that's already, and that's why, in my view, there should not be any concern about capacity, because whatever we have said earlier also, we have fulfilled that.
Thanks a lot, sir.
Thank you. Ladies and gentlemen, we take that as the last question for today. I would now like to hand the conference over to Mr. Puneet Dalmia for closing comments. Over to you, sir.
Once again, thank you all for your participation. And I know this has been a tough quarter for us with some demand compression as well as sudden increase in cost spikes. But I think I'm very positive about the future. We have seen this before. We have been in this business for many decades, and there will be bumps along the way. But I think I have never been more positive and more convinced about a bright future for our country as well as our company. So once again, we continue to march ahead with our capex plans. We continue to become more efficient. We continue to become more green. And, we are confident, as I said in my earlier calls also, that the best for the company is yet to come. Once again, thank you for your feedback and wish you all a great 2022 and look forward to catching up with you in our next earnings call. Thank you.
Thank you. Ladies and gentlemen, on behalf of Dalmia Bharat Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.